Okay, today I want to go over some of the key topics from Chapter 10, which covers various aspects of life insurance. Um, the purpose of life insurance is to provide some financial protection for people who depend on you in your income if you were to die. You purchase a life insurance policy from an insurance company, and basically it works that they agree to pay you a lump sum of money, let's just say $1 million, that will be paid to a named beneficiary at the time of your death. Um, you would also, in typical policy, have secondary beneficiaries. So, for instance, you might name your spouse as your primary beneficiary and your children as your secondary beneficiary. The purpose of insurance, um, I put it into a couple categories. For almost everyone, it's to pay off your home mortgage or debts that you have. Um, you also, by having insurance, can provide money for education for your children. It also then, in many cases, you'd have enough money after, for instance, paying off your house mortgage and the debts, and maybe setting aside money for your children's education, able to set aside money, and your survivors would be able to generate income from the money left over. If you have $1 million life insurance policy, $200,000 might go to paying off your mortgage and your debts. You might set aside $200,000 for education expenses for your children, and that will leave $600,000 remaining. And you can use that $600,000. You can have that money set aside, and it would generate a flow of income for your survivors. And that would partly offset, for instance, the loss of income that you yourself have. Um, Let me say that uh, um, the book discusses a variety of reasons. A couple of them are bad. I think bad motivations for life insurance. One of them would be to provide retirement income. So again, consider yourself if you were a married couple and you view you dying that life insurance policy generating income for your spouse. You can't. That's a extremely risky approach towards retirement income. Um, and you also get viewed as a way of accumulating savings. That is, you can build up money in your life insurance. It's like a savings account. Again, this is a really bad way to think about life insurance. Life insurance really is a way to basically provide an income flow to surviving people in your household in if you die particularly young. Um, the key idea about life insurance is what I have here on this page, which is large numbers. Insurance companies to make life insurance policies or insurance policies more broadly viable, you need a large number of people. And so the idea is if I can get enough people to purchase life insurance from me, um, and these companies collect a lot of information about mortality, so the odds of you dying in the next year or the next 5 years or the next 10 years. Mortality tables are refined over time. They're differ by your age, 30 versus 35, by whether you're male or female, whether you're a smoker or non-smoker. Basically, they ask you information about yourself, and then they can use the information they've collected to try to calculate what's the chance of you dying, your life expectancy, whether you're going to die. Say if you're age 30, they expect you to live on average to say 72. So when they create these insurance policies, they're hoping with large numbers, that is, that they have enough people. While some people might die a little earlier than they expect, that'll be offset by people living longer than they expect. So on average, the insurance company is going to make money because they will be collecting enough in premiums from their clients. Many of their clients will actually not collect on the insurance, and that will generate enough money to pay off the people who need the insurance. Um, One thing you'll have to do is when you think about buying life insurance, is you have to decide how much insurance to buy. The book talks about something they call the easy method, which is 70% of your salary for 7 years. So that's about 4.9, which is rounded to say five times your annual salary. So if you have a salary of $100,000, under the easy method, they recommend that you have $500,000 policy. Um, that's a fine, quick, and dirty method. The book discusses a couple more. Probably the best method is the family need method. When you sit down and think about getting life insurance, either you can find online websites that help you do this, or you can meet with an insurance agent. And basically, you might go through a more thorough evaluation of your needs. So, for instance, um, a $500,000 policy, the easy method might suggest that might not be enough if you have, for instance, two young children and a recently purchased house where you have a large mortgage on it. Um, $500,000 may not come close to meeting the needs of your families. On the other hand, it's quite possible the easy method would involve you purchasing more insurance than you in fact need. So in most cases, it probably makes sense to use the family need method, which is basically a more detailed approach to calculating exactly how much your surviving spouse and family members would need in case you were to die. There are several different types of life insurance policies that are discussed in the book. Here in this overview, I'm just going to talk just about the first three, which are the three main types of life insurance. Um, Term life insurance now is the most common type of life insurance that people are purchasing. And so what term life insurance is, it's protection for just a specific period of time. And if you stop paying the premiums during the period of coverage, your coverage actually stops. So the idea of a term life insurance policy might be that you buy insurance and it's just for the next 25 years. So suppose you purchase term life insurance when you're 35 and you bought a 25-year policy. That would cover you until about age 60. But at that point, you made all your premiums when you turn 61. Your term life insurance policy is no longer in effect. And if you were to die when you're 61, you would click zero off your term life insurance. So term life insurance is a policy where you kind of figure out how much money am I going to need till how many years till I can pay off my mortgage and how many years till my kids are out of college. You kind of calculate the period of time which you're going to have a lot of expenses. If you were to die early, those expenses you still like to have paid. You'd like to have your house paid off, and you'd like to have your kids go to college. And so term life allows you just to buy just insurance just for the period of time where you're going to have others really dependent on your income. When you're 65, your kids are grown and out of the house, your house is all paid off. You may not need life insurance because if you were to die, there may not be other people who are dependent on your flow of income. Whole life insurance is kind of a traditional way insurance was offered. It's not as popular today, mainly because it's a lot more expensive. So, as the name implies, whole life insurance will cover you throughout your entire life. It wouldn't end after, say, 20 or 25 years. The term insurance expires at the end of the specified term. You pay a premium in most cases for whole life insurance. You pay as long as you live. The premium typically is determined at the time you purchase the whole life insurance, and in most cases, whole life insurance you pay the same premium throughout your whole life. You might pay $800 every year for the rest of your life. In addition to having a life insurance component, a big difference between whole life insurance and term life insurance is that whole life insurance accumulates cash value and it allows you to borrow money, potentially draw money from your whole life insurance. So basically, a whole life insurance is a kind of a combined policy where it's providing life insurance and an ability to actually, in some sense, have a saving so you can extract money from your whole life insurance if you need to collect money, have some extra flow of money after you've built up this cash value. The problem with whole life insurance is the real attractive part of it for many people is this cash value. It turns out that it's priced pretty high, and therefore the rate of return that the money that goes into the cash value is really low. And so for most people, they're better off by buying a term life policy and then setting up some other vehicle to set aside some money to save for a rainy day. Right? That's if you think of that as like the cash value of the whole life insurance. Almost in every case, whole life insurance is dominated by term life insurance. And you might say, well, Professor Pusha, I'm only 20 or 25 years old. Well, then I would say if you're concerned and you want a really long period of insurance, like whole life insurance, you can buy a 40-year term life insurance. You don't need to buy just a 10 or 15 or 20-year period. You can buy a real long term life insurance that will still be a better financial deal for you than whole life insurance. So whole life insurance is really fallen out of favor because it's just too expensive. Another common type of life insurance is often called group life insurance. It's a type of insurance that most typically people see where it's offered through your employer. So, for instance, you might graduate, you get hired by Johnson & Johnson, and as part of Johnson & Johnson's employment, while you're being employed by them, they offer you an insurance policy that might be typically something like 2 or 3 times your annual salary. Not nearly as much as a term life insurance you might purchase on the open market, but usually it's a benefit that you get from your firm. The other thing that's attractive about group life insurance is in many cases, in fact, I'd say most cases, a physical is not required. You're able to get insurance through the company. If you get term insurance or whole life insurance, you have to typically pass a health exam. And in some cases, some people are unable to get life insurance on their own, but can qualify for group life insurance. The thing I want to stress about group life insurance, or just life insurance more generally, is that insurance agents make a lot of money selling life insurance, especially whole life insurance. So it usually can be the commission on a life insurance policy is equivalent to 1 year of your payment. So if you buy an insurance policy, say a term policy, it's a 20-year policy, the agent will make 1 year of your payment. It goes to the agent. And so what you need to be careful about, that's okay, I have no problem with that, but what you need to be careful about is that the agent recommends the best insurance for you, not the policy that generates the highest commission for him or her. So it's important that after you talk, if you decide to call insurance agents, you actually make an effort to compare cost and policy features. So I've listed 2 websites here, AccuQuote and iQuote. There's other online sites that give you insurance quotes. And I want to stress that you really need to shop around for life insurance. If you're not careful about this, you might pay 20% more. So instead of, let's say, paying $1,000 a year for insurance, you might pay $1,200, $1,500 each year for insurance because your agent has purchased a policy that is just not the best policy for you. So it's really, really important. It's really super important to do your homework when you buy life insurance. Okay, spend a little bit of time shopping around. It doesn't take a lot of time. A couple evenings searching the internet. You can make a few phone calls. You'll be able to get a much better idea about what the kind of a good price with a good policy is, rather than just taking the first policy your agent offers. It might be the case that your agent offers you the best possible insurance, but it might be that you're locked in with that agent is locked in with a specific insurance company, and that company doesn't offer the best rates. In that case, I really recommend you shop around and find the best rates. One thing I want to mention that is related to insurance, it's really the flip side of insurance, and that's annuities. Um, Annuities really are kind of insurance turned upside down, right? Think about insurances. Insurances, you pay a certain amount of money each year, and then in the case of You die and you get a large payment at the end. All right. An annuity, you do the opposite, where you pay a huge amount of money up front, say a large amount of money up front, and then you receive income based on that. So, for instance, you might put $500,000 into an annuity, and then each and every year you get a flow of money. So it's like a bank account in a sense. But the difference between an annuity and a bank account, where you get interest payments from your bank account, is that the annuity generates money for as long as you live. Okay, so again, just like what they do with calculating insurance, they use life tables to try to figure out on average how long will they have to pay an annuity out. And then they price the annuity according to your risk type. So for instance, you might pay $100,000 to buy an annuity, and they might tell you, well, we'll pay you $3,500 every year as long as you live. And there might be someone else, let's say a comparably aged female, as compared to this male who got 3,500. The comparably aged female may only get $3,300 every year. Because of their calculations, they might have determined that the female is going to receive the insurance for the annuity, for a longer period of time. As with insurance, it's really important that you shop around for annuities. Annuities are notoriously expensive. That is, the fees involved in getting the annuity are quite high. When I say you pay $100,000, in that $100,000, it might be that $10,000 of it goes to fees, and really only $90,000 of it go to buy the annuity. These are very expensive, potentially expensive products, and again, it's your best interest to shop around for an annuity so you get one that generates the most income from you from a reliable insurance company. That's the highlights for Chapter 10. Good luck.